Hi, and welcome to the Esade Innovation and Knowledge Management Institute seminar series. We have here today Mircea Epure, professor from University Pompeu Fabra. Mircea, thank you for coming, and thank you for joining us for the podcast. Can you share, please, with our listeners and viewers a little bit about yourself and the presentation you gave today?
Thanks a lot for the invitation, Ivanka. This was a great experience with the Esade group. I am associate professor at Pompeu Fabra, and I started my academic career with a European doctoral program between Autonoma in Barcelona and the university in southern Sweden. And after a back and forth between these two very different cultures, I have concentrated my efforts on studying the implications of the governance of small and large corporations for heterogeneous performance effects.
Excellent. So today you helped unpack one of the big and important areas in terms of investing in innovation and ventures, and that is the venture capital perspective. Can you tell us a little bit more about what you bring to the table when it comes to the debate?
Look, in this paper, we want to break this monolithic approach to venture capital investment and show that the behavior or the manner of investing of corporate venture capitalists who have increased a lot in the recent years, and independent Silicon Valley style venture capitalists is quite different, as they are able to exploit different information advantages, and they also have different motivations. So, for instance, corporate venture capitalists are interested a lot into integrating strategic knowledge from the invested company into their parent company, such as, imagine Google Ventures, right? So it's a strategy for Alphabet. Independent venture capitalists such as Sequoia care a lot about short-term financial return. Corporate venture capitalists are incredibly good at identifying information advantages which are crucial in the startup arena, knowing industry trends, or, in a geographical space, what investment could be better for your strategic goal. But on the other side, corporate venture capitalists don't want to be perceived as sharks, controlling the new venture, but rather would like to, observe and learn from it. Whereas independent venture capitalists are very good at due diligence, the investment process, at monitoring this investment process and fostering, future performance of the venture through successful exits, such as IPO or acquisition. So what we say is that corporate venture capitalists, with an information advantage, they prefer not to syndicate, not to go within their own network and invest together with other corporate venture capitalists, because this could lead to intra-organizational spillovers.
So some competition, basically, between
competition, for the appropriation of the strategic value of the investment, and therefore they may look for advantages which they don't have, which is this monitoring of the investment process, and thus syndicate with independent venture capitalists who are central in this venture capitalist network. So this type of investor is known to be one of the best solutions for increasing the valuation of the company through better monitoring. And in the end, a syndicate, from the perspective of the corporate venture capitalist, a syndicate with a corporate venture capitalist with an information advantage, going at it alone from the corporate perspective, but syndicating with connected independent venture capitalists, could bring the best of the two worlds to the table. So, the knowledge on where to invest from the corporate venture capitalist, and the effective monitoring of the independent venture capitalist.
Excellent. So this is very interesting insight, right? Their differences actually bring them together as an investing syndicate. But what does that mean in terms of a next step for you? Now, having established and empirically shown that these two are allying, so to speak. What do you want to do next?
There are two elephants in the room. Elephant number one is, are the firms invested in by this type of syndicates, this composition of a syndicate, performing better or not in the future? Yeah. Are they showing better valuations, more successful IPOs or acquisitions or not? So this is one next step. And the next step is to show, from what economists like to call a real effect analysis, or what policymakers would really love, is whether in the regions where this happens, in these subnational geographical spaces, the interaction of such investment with the local environment brings more growth.
Very interesting.
So we could speak to more audience.
Mircea, we look forward to seeing the sequel as well. Thank you very much for joining us. This is the IIK Seminar series.